Pensions are the single largest component of household wealth in the UK. They made up over 42% of household wealth in 2021, with 115 billion contributed to workplace pensions by 23 million people and their employers. How we tax pensions has a big impact not only on how much money the government raises, but also on redistribution and inequality. Income tax, the single biggest tax in the UK, is applied differently to pensions than it is to other kinds of saving. If you choose to save some of your salary in a bank account, you'll pay income tax not only on your wage, but also on the interest payments you earn on those savings, although most people are allowed to take £1,000 of interest income a year tax-free. However, when it comes to withdrawing your savings from the bank account, there'll be no further tax to pay. Pensions work differently. When you put income into a pension, you delay having to pay tax on that income until you retire. Any part of your salary contributed to a pension is entirely tax-free, as are any investment returns your savings earn while they're in your pension. Unlike a bank account, however, you'll have to pay income tax on your pension when you withdraw the savings in retirement. That means, for the purposes of income tax, pension income is treated as if it had been earned in the year you withdraw it in retirement. Delaying tax in this way can be an advantage if you expect to have a lower income in retirement than you do in working life. As well as allowing you to delay paying tax on your income, pensions also benefit from a tax break in retirement. When you take income out of your pension, 25% can be withdrawn entirely free of tax. This exemption is most valuable to those who have the highest incomes, and therefore the highest tax rates, in retirement. By the same token, being allowed to withdraw 25% of a pension tax-free is of no benefit to the almost half of pensioners whose incomes are so low that they already pay no income tax. For example, imagine a pensioner who each year receives £20,000 of income from a private pension and £15,000 a year from other sources. Normally, this would mean incurring an income tax bill of £4,000 on their £20,000 of private pension income. However, the tax-free 25% reduces this to £3,000, a saving of £1,000. Now imagine a pensioner with the same level of private pension income, but who also receives £60,000 of income from other sources, such as investments, salary, and the state pension. Normally, the individual's £20,000 of private pension income would incur a tax bill of £8,000. However, the tax-free 25% reduces this to £6,000, a saving of £2,000. Put simply, those with higher incomes in retirement make bigger tax savings as a result of the tax-free 25%. National insurance also works differently for pensions. National insurance contributions are the UK's second biggest tax and are usually charged on all earnings. Contributions are made both by employees and by their employers. For individuals who put money in their pensions, national insurance is paid in the normal way and can't be delayed like income tax. As a result, national insurance isn't charged on income when you withdraw from your pension. By contrast, any money that your employer contributes to your pension is completely exempt from national insurance. Because national insurance isn't charged on pension income, that means employer pension contributions escape the tax entirely. This represents a large subsidy to pension saving and involves the government giving up around £23 billion a year in tax revenue. Pensions also receive special tax treatment at death. If a person dies before they've used up their pension pot, it can be passed on as an inheritance. Whoever inherits the pension can withdraw the income whenever they choose, but when they do, any income removed from the pension will be subject to income tax. However, if a person dies before reaching the age of 75, then whoever inherits their pension will pay no income tax at all on money they withdraw from it. Pensions are also unusual in being entirely exempt from inheritance tax. The result is that pensions are an extremely tax-favoured vehicle for inheritance. This used to matter less because pensioners were previously required to use their pension pot to buy an annuity, a guaranteed lifetime income, leaving limited scope for pensions to be inherited. However, in 2015, the government changed the law, dropping the requirement to buy an annuity. The result is that pensions are likely to become an increasingly significant form of inherited wealth in the coming years and decades. This work is funded by the ESRC and Aberdeen Financial Fairness Trust. To find out more, please visit www.ifs.org.uk.